Most new traders think that they have to predict market direction and be right in order to make money. But did you know with options, you can be outright wrong and still make money? And if you happen to be right, you can make a lot more. That's the power of options. And if you're not utilizing them in your trading, you need to watch this video. I'm Seth Freiberg, head options trader at S&B Capital, and we're one of the top proprietary trading firms in the world with numerous 7 and even 8-figure per year traders. You've found the right place to learn. Hi, I'm Seth Freiberg, and I'm the head trader of S&B Capital's options trading desk here in Manhattan. And the equity traders on our desk frequently ask me for structural ideas for trading concepts that they have, which for one reason or another, they'd prefer to express using options as opposed to using equities. And so one of our very experienced equity traders, Mike, had noticed something interesting about the price of oil relative to the price of oil stocks, such as Exxon, which trades under the symbol XOM. You see, the price of oil and oil stocks generally move in sync with each other. For example, if you look back at June 8th of this year, earlier in 2022, you'll notice that the price of oil began to sell off and followed through from 122 down to 96 by mid-July. So if we turn to Exxon, we see that the same thing happened, that it sold off from 105 on exactly June 8th down to 85 by mid-July. And that's normal. Oil futures and oil stocks tend to strongly correlate with each other, as they did in this case. However, if we now expand out to late November, we see that while oil continued an orderly sell-off down to 81, XOM and other oil stocks actually bounced and reached 52-week highs in that same time frame through to late November. Well, Mike happened to know, because he follows oil stocks closely, that in the last 30 years, believe it or not, there have only been 3 occasions where the price of oil dropped 10 to 20% simultaneously with oil stocks reaching 52-week highs. And in each of those cases, the oil stocks within a month or so pulled back 5 to 10%. And so Mike reached the conclusion that this current divergence is basically a fluke, and that it was inevitable that this divergence would come to an end and that oil stocks would rejoin their historical correlation with the price of oil to some extent, and that this was simply a matter of time. And so Mike reached out to me and asked me if I could come up with an option strategy that would be profitable if Exxon pulled back by the end of the year as he anticipated. Of course, he couldn't be sure of the exact timing of this move, but he felt strongly that it would, in fact, transpire. Now, before we get into the details of the oil stock strategy that we came up with through this collaboration between Mike and I wanted to let you know that beyond what we'll be teaching you in this video, if you'd like to learn 3 more option strategies that our pro traders use all the time, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. In order to go over how this option strategy on Exxon works, I need to make sure that you're clear on how equity options work. And I realize that most of you probably know something about how equity options work, but just for a quick review, and this is going to be fast, what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock is going way above the strike price of the call, the call buyer can exercise his right to buy 100 shares at the strike price. In other words, he's entitled to buy the shares way below market. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put. In other words, he gets to sell them way above market. So naturally, all other things being equal, when a stock price goes up, a call option for that stock will go up because that right becomes naturally more valuable to the buyer. And when a stock price goes down, a put option for that stock will go up because that right naturally becomes more valuable to the buyer as well. But it's also important to keep in mind that at expiration, if you've sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call expires worthless and the call seller just pockets the premium. Similarly, if you've sold a put and the market closes above the strike price of the put, then again, unless the put was previously exercised, it expires worthless and the put seller just pockets the premium. So those are the basics of call and put equity options. Keeping that in mind, let's move to November 28th. And as you can see, with Exxon trading around its 52-week highs, suddenly there was a gap down. And XOM, having closed the previous day at 113, opened up at 111 and pretty much stayed there for the rest of the day. And so a few days later, having received the crucial price confirmation of his thesis, Mike put on the following trade, which we designed together. Mike's thesis was that Exxon would break down further along with the other oil stocks by the end of December. So we pulled up an options chain that expires on the last trading day of the year, December 30th. And what we worked out was for Mike to buy 75 of those 113 puts for $4.97, sell 150 of the 107 puts for $2.36, and buy 75 of the 104 puts for $1.54. Now, this particular strategy is known as a broken wing butterfly to professional options traders, and it's a powerful way to express a bearish position on a stock. Now, let's break down the cash flow of what just happened here so that everyone's clear on the parameters of the trade. And so starting with the 113 puts, you could see we paid $4.97 for those. But remember, each equity option represents 100 shares of XOM stock. So you multiply that by 100, and he bought 75 of them. So the result is a cost of $37,275 for those puts. Now, at the same time, he sold 150 of the 107s for $2.36, which results in cash inflow of $35,400. So you deduct that from the cash cost, but then you add back what you paid for the 104s, which, as you can see from the calculation, is $11,550. So when you net it all down, the final result is a cost of $13,425, which is the most you could possibly lose. Although traders will not let it get anywhere near that large of a loss in reality, as they're going to have a stop on the trade at a far lower number than that. In any event, let's now move forward to the day that we're making this presentation. As you can see, XOM did as Mike predicted, sell off further, beginning to get back into sync with the price of oil itself. And so the pricing has changed on the options that comprise our broken wing butterfly. The 113 puts increased in value because XOM has dropped so many points since we put the trade on initially that those increased greatly in value. The 107 puts, on the other hand, are at essentially the same price as the entry price because the stock is hovering around the 107 strike price with only 11 days to go, while the 104 puts have actually lost a fair amount of value because the market is losing faith that XOM is actually going to reach 104 and therefore might expire worthless. So those have become devalued as well. And as a result, if we were to exit the trade on December 20th, we'd need to reverse the transaction that we originally did. We sell the options that we bought and we buy back the options that we sold. So if we did that, as you can see from the calculation using the new prices updated to December 20th, you'd cash the 113s in for $52,125. You'd buy back the 107s to close those short positions, spending $35,400, and in the process, cashing the 104s in for $6,900. Now, once you do that, also, of course, you have to subtract out the original cost of the trade to arrive at your final profit, which once you net it all down becomes a profit of $13,050, a return of more than 97% in 3 weeks, which is obviously not too shabby. Now, it's also important to point out something really interesting here, and that is that the trade, of course, didn't have to play out this way. For example, let's consider this scenario where XOM did not go down as Mike had predicted, but instead went up slightly. How would the trade have done? Well, let's look at that. Let's suppose that instead XOM had rallied from its original price of 110.42 up to 111 on December 30th, and the options expired. What would be the outcome of the individual options? Well, let's first look at the 113 puts. At expiration, they would have had a value of $2, right? Because if someone owns that option, they have the right to sell XOM at 113 while the stock is trading at 111, meaning anyone who owns that put can turn around and make $2 immediately if they own 100 shares of Exxon, because they can sell those shares for $2 more than they're worth in the market, which would mark his trading account up $2 per share. And so if we sold those puts right before they expired, the market would pay us $2 for those. And the 107 puts that we sold, well, those would have no value, as would the 104 puts below that, because no one wants the right to sell shares at a price below what they could get for those shares in the open market, which in this hypothetical case is 111. And so both of those, the 107 and the 104, have no value on expiration. So if we go back and determine the final value of the broken wing butterfly, if XOM were to have closed at 111 on December 30th, the day the position expires, you can see that the only position that has any value is the 113s, as we discussed. So we cash those in and collect $15,000, as you can see from the calculation, and the only other consideration is subtracting the original cost of the butterfly, which was that $13,425, resulting in a profit of $1,525. Now that's actually pretty extraordinary, right? Because the stock went up, but we still made money on the trade, and that's due to the incredible property of option strategies, which can make money on trades even if you're wrong on the direction of the stock within reasonable boundaries. And so what I'd like you to take away from today's video is that bearish option strategies, such as the bearishly located put broken wing butterfly that we reviewed in this video, are very powerful and can yield incredible returns if you're right on direction. But perhaps more astoundingly, if you're wrong on direction within a reasonable range, you can still make money on the trade because of the unique property of option strategies, which once learned, as our professional traders can attest to, a whole world of possibilities opens up, allowing you to execute really high probability trades, such as the example we shared with you in today's video. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of S&B Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part? You don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.